All right. Matt and Abby, it's awesome to get to powwow with you this afternoon. I have a not so big, beautiful head cold today. So I'm excited that I'm with you experts that have done thousands of tax incentive studies because you guys can kind of take it home for us today. But hey, the big, beautiful bill, a lot of us in the tax world, we've been on our toes for months. We weren't sure that anything could get pulled off by July 4th, but here we are. Probably not totally surprised because every day is sort of a surprise with this administration here in 2025. But there are a lot of exciting things to unpack for founders and business owners. And, some not so fun pieces of legislation that didn't make the cut or might have gotten stifled a bit, but we're going to actually talk about how those things can actually be a positive here in 2025 and onwards. So we're going to dive in today on what founders, CFOs, and real estate pros really need to know with this big, beautiful bill that's hit our lap this month. So meet your speakers. Hi, everyone. I'm Ari Salafia. I'm the founder and CEO at Tax Taker. I'm joined by our amazing leads, Matt Bechtold and Abby Massey. They've run thousands and helped thousands of companies navigate complex tax incentives. So they are probably the best resources to bring into this webinar today with some of the changes that all these business owners really, really want to know about. I'll let you guys toot your own horns here in a second, but we're gonna just go over what the agenda looks like today. We're talking about the one big beautiful bill just got signed July 4th. It was a sweeping federal tax package. We're talking almost 1,000 pages of legislation, no small change that are impacting key incentives and also have opportunities for some major savings. The main incentives we're going to cover today are going to be on the energy and real estate side of the house. That's where we have a ton of interest because there are some heavy hitting programs that have a lot of value for building owners and designers. We're going to talk about cost seg and bonus depreciation. We're going to be talking about a big crowd favorite right now, the R&D tax credit. And then we're going to sprinkle in some key business owner and actually executive kind of incentives that folks need to be taking a look at. And then we're also going to be talking about how timing and timelines come into play. All right, Abby, I'm going to kick it over to you. Let's jump right into these energy and real estate incentives. A lot of talk about your domain being 179D and some of these ancillary programs. So
Yeah,
what are
thanks,
you
Lori.
seeing?
Yeah, nice to see everybody today. Abby Massey, Vice President of our Energy Incentives Practice at Tax Taker. I've been at the real estate and energy incentives world for just shy of 10 years. It'll be 10 years this year in October. So a lot of experience with the programs and the way they've changed over the years. We're not going to cover everything that's in the big, beautiful bill. There's a lot of energy incentives that were impacted. Really, this is kind of the four that I think are most relevant to the crowd that we've been speaking to. But feel free to send a note after the webinar if you want to talk about any of the other incentives. So we'll start with 179D. 179D is the Energy Efficient Commercial Buildings Deduction. It was passed in the Energy Policy Act of 2005. So it's been around for about 20 years. It was prior to the One Big Beautiful Bill, a permanent fixture of the tax code. So 179D was made permanent in 2021. It's been a permanent fixture there for now a few years. And in the Inflation Reduction Act, it was enhanced to give several benefits to building owners. So we got an increased deduction amount of up to $5 per square foot. It made the opportunity for tax exempt owners to allocate deductions to their designers, and it introduced an alternative method to calculating energy efficiency that made it just a better opportunity all around for either building owners or designers who help government and tax exempt organizations claim this particular incentive. So with the One Big Beautiful Bill, unfortunately, it's not the best news for 90, but we're actually not in unusual territory here. So they added a termination of the program in 2026. What that means for this program is that any building that begins construction before June 30th of 2026 will still be eligible. So we have some time for projects to get moving forward and still be able to claim this benefit. The requirements are all the same from the IRA, however. So we still have the benefit of up to $5 per square foot. Still, the tax exempt owners can allocate that out. And so there's still a lot of value to be claimed here. Now, the one thing I like to highlight about beginning construction in the terms of the IRS, two things. First, that actual physical work begins on the project. So that could be actual site development. That could even mean if you have custom parts being manufactured off site, that could be the beginning of construction. So something to keep in mind. But the other term that actually is a definition with the IRS is that beginning of construction can be marked when 5% or more of the total costs have been incurred by the building owner. This is great because, as we know, the folks here that are in the construction industry, lead times are still long for some equipment. So if there are initial deposits that are being made on the equipment that total up with the design fees up to 5%, as long as you continue progress on the project, it doesn't get shelved, then that can also be considered the start of construction. So I think there's going to be a lot of opportunity here for projects that'll be placed in the service several years out, but that is the new rule to be most aware of.
Yeah, that's pretty huge, right? I mean, people don't they think, oh gosh, I only have a year left. But in actuality, these buildings and projects span many, many years. So
Yeah,
we could be talking
absolutely.
about, even tax year, and then in tax taker land, we always live a few tax years ahead and a few tax years behind.
That's exactly right.
So we could be, looking at these projects in 2028 or 2029 even.
I would expect it. For our folks on the call who work on large scale new construction, you could still have projects several years out that you're able to claim. And by that time, we might be seeing an extension of the program, which I'll chat about here right as I'm wrapping up.
Awesome.
All right, let's jump over to what I consider kind of the sister to the 45L tax credit. This is generally for developers who are going to build, lease, and sell either multifamily or single family homes. This program is not for residential homeowners. So if you own your own home, you wouldn't be able to claim this. There's incentives there specifically for you, but this is more for the developers of those types of properties. So the original law, again, 45L, changed in the Inflation Reduction Act, allowed for up to $5,000 per credit if you were to get a Zero Energy Ready Home Program certification. On a lower tier, if you got Energy Star certification, you get $2,500 per unit. That is the new law. So it's pretty straightforward. Vacation means that you would be able to get that credit. The new law is going to terminate this program as well. Again, it's a sister to 179D, so this doesn't come as a big surprise, as the programs are really similar, but the way that it is terminating is slightly different. So in this case, the termination date is still June 30th, but this is for units that are leased or sold before that date would be eligible, or anything that was leased or sold after that date would be ineligible. So now instead of talking about start of construction, we're talking about not only end of construction, but actually getting into contract to have those sold or leased. So really for the 45L program, if you're doing multifamily work and you're pursuing Energy Star, I would say this one has probably the tightest time frame and you should be looking at it right away. We want to make sure you can capture everything that you can. And if you aren't able to get this and you are only pursuing certification for the fact of claiming, well, we want to make sure that you either don't spend costs on that because you aren't going to make that timeline, or we get you really in line to make sure that this all happens and so that you can claim that benefit. The other little change, Ari, that I like to talk about is that Energy Star itself has actually been defunded at this point in time. So I do expect if 45L comes back in line, maybe it gets extended in a tax extenders package, it very well may have different rules in place. So again, if this is a program that if you closely pay attention to or you actually utilize yourself, I do expect some changes in the next few years.
And this is not your first rodeo with these packages being extended or having lapses.
That's right. That's right.
I know our inboxes have been getting blown up over the last few weeks, even prior to the signature, because they're wondering kind of what happens if, this goes away or can it come back? I know that's a question you've been fielding a lot of. Can you kind of just share with the audience? I think you have a unique perspective about this. I know Matt does with R&D too,
Yeah.
but I think it'd be worth hearing about.
I think in the last couple of years, especially with the really strong energy incentives that came into fruition from the Inflation Reduction Act, they gained a lot more attention in the industry. And so, with that comes a lot of inexperienced folks seeing for that these terminations have been introduced in the programs, and it's a little bit scary, right? The language is scary, but in truth, most of these programs were never permanent at the beginning or the onset of when they were introduced. So, back in 2015, when I started with working on one D studies specifically, the program was always had a termination date and it was always included in tax extenders packages every few years. So I expect that to happen again. I know we're talking about end of program dates, but based off of my experience, I really do expect these to come back online at some point in time. What the administration looks like, what their actual goals are and priorities are in the next few years will dictate when these do come back. But I think we all know here energy is the future. And so you will see these programs come back in some shape or form. They just may look a little bit differently because now they have the opportunity to rewrite them as they get renewed.
Absolutely, which can be extremely promising. And, the IRS always has to take some time to catch up to make clarifications, anyways, for even permanent programs. So we'll be definitely staying tuned and providing updates along the way. Investment tax credits. This one
Yeah,
got
yeah,
got
I
some
think
changes too.
this is one that a lot of folks in the industry have their eyes on. So investment tax credits are for renewable energy property and then also a few others such as geothermal heat pumps as well as thermal energy storage. These were a credit that was a percentage of the costs that you spent on the program. So really, really valuable. It's even available through elective pay, which allows local and state governments as well as tax exempt organizations to benefit from a program they normally wouldn't. So, of all the programs, there was a ton of value coming from this. As a part of the new law, there's been, I would say, a little bit of a target on the back of solar and wind. And so they very specifically have a termination date of the end of 2027 for your projects to be completed. Again, remember the terminology for each program is just a little bit different. So it's important to remember those rules. If a solar or wind project isn't completed by the end of 2027, then it unfortunately would be ineligible for the credits. So if you're working on one of those projects or planning one of those, I recommend you get started and figure out those timelines right away. The other systems, however, in these credits, geothermal, energy storage, other carbon neutral technologies like hydrogen, there are pretty much remain untouched. So we still have the same time frame. For most of those programs, it's going to be through the end of 2032 to be able to put those in service and claim the credits. Elective pay is still available. So our tax exempt building owners and our government building owners, they can still claim it. But the other caveat here is foreign entities and leased property holders. So if you were to do energy as a service in one of these types of projects, are now ineligible for the credits. They've added some extra language there. Again, I think they're trying to really incentivize those who are actually who are
Sounds like a big theme here.
yeah, yes, absolutely. All right.
Good old cost segregation.
Last but certainly not least, we saved the best news for last, which is why Matt gets to go second. But cost segregation is a program that's been around for a really long time. It's essentially available to building owners or folks who acquire buildings and are placing those into service and taking depreciation deductions on a 27 and a half or 39-year lifespan. Originally in the Tax Cuts and Jobs Act, It was phasing out bonus depreciation, which does impact the amount of deductions that you can claim in the first year after you do a cost segregation study. So every year we were getting a 20% drop until we hit 0% bonus depreciation. Now the new law has made 100% bonus depreciation permanent. So that's wonderful news for any folks who are claiming cost segregation. This is going to be eligible for any properties that are placed into service or acquired after January 19th, 2025. So properties actively now. And it's going to increase the benefit that you see from these studies. So anything that you can recategorize into shorter recovery periods, they will be eligible for bonus depreciation, which is going to make this a really, really valuable tool for building owners. So great news on the cost segregation front.
Yeah, absolutely. And I think still, with interest rates still pretty high, higher than most would like, this is going to be a really nice mechanism for those folks to get, quite a bit of equity into a property that they're putting into service right away in the new year.
Absolutely. The
Kind
other
of levels
note,
the playing field.
it does. It really does. And cost segregation in 179D for building owners is they're calculated differently, but the tax mechanism is very similar. And so those programs pair really well. Cost segregation will provide the majority of the value, but 179D can actually tack on extra value on top of that. So the strategy to stack and layer these incentives is really important, especially as they're still available.
It's a great point. It's not that you have to choose between them. You can have both.
Exactly. Don't
Love that.
choose. Take them both.
Don't choose, just get both. We love a good tax. That's another thing. We love a good tax stack.
That's
All
right.
right. Thanks so much, Abby.
Of
Now we're going to
course.
move over to the golden child of tax incentives. It has not been the last few years. Matt has had to say, sorry, a business owner or startup or anyone that hears Section 174 for a few years, but R&D is back, baby.
That's right.
Let's talk about it.
Yeah, we're excited. So, hey everybody, I'm Matt Bechtold. I lead the R&D credit practice here at Tax Taker. Been doing this just R&D credits, helping clients claim them for 15 years or so. Large companies, small companies across industries. So yeah, really happy to be speaking to you today. So for R&D, the BPB changes are generally positive. So just some history. So as a reminder, prior to 2022, payers could expense all those R&D costs in the year incurred. Before 2022, imagine you had $1 million in those 174 R&D expenses. You could deduct that full million in that tax year. But beginning with tax year 2022, taxpayers had to capitalize and amortize those R&D expenses over either 5 years for domestic R&D expenses or 15 years for foreign R&D expenses. So pretty painful. Going back to that example of $1 million worth of domestic R&D expenses, under these rules, in a given year, you could only deduct 100,000 of that million in the year, and then the remaining 900,000 or so would be amortized over 5 years. Clearly, this meant that businesses weren't deducting the full cost of R&D in a given year, and then because you have reduced deductions, of course, you have higher taxable income. So that's the way it was, but the good news is that we're back to the pre-2022 treatment of domestic R&D expenses. So as already mentioned, we're really excited. We've been waiting for this for several years. We've had so many conversations. It's looked like it was going to go through multiple times. Finally, finally it's gone through. So we're really happy. So going forward, what this means is that beginning with tax year 2025, so tax years that begin after December 31st, 2024, all taxpayers can deduct those domestic R&D costs in the year incurred. So $1 million in R&D costs in 2025, you can deduct those. Only caveat is that foreign R&D costs still have to be amortized over 15 years, so that last bullet point. So domestic, fully deducted. Any foreign R&D costs, maybe you have a software developer overseas, that still has to be amortized over 15 years. So that's going forward. In order to recover those expenses, so you've been capitalizing and amortizing expenses over 22, 23, and 2024, all businesses now have the option to accelerate those deductions. You can take those unamortized domestic expenses from 22 to 24 And you can either deduct them all in 2025, or you can spread it evenly over 2025 and 2026. Again, though, that only applies to domestic R&D expenses, so not those foreign expenses. And then small businesses have an additional option. Small businesses are defined as those with 31 million in gross receipts or less. So if you meet that definition, and that's average annual gross receipts, 31 million. If you meet that definition, you can actually apply this retroactively. That means that you can amend 22, 23, 24, deduct all those domestic expenses you incurred in the year. Again, not foreign, only domestic. That could be a good thing. And then alternatively, you can keep amortizing these. If that makes sense for your tax strategy, you can keep on amortizing. So there's some flexibility here.
Yeah, I think that it kind of goes to the spirit of the R&D credit. I think folks forget the whole spirit of it was, right, to create job growth here in the US and keep us competitive in our innovation. We know, though, especially, with software, talent is global. So we've never been able to, am I right? Like we've never been able to include foreign expenses into the calculation, but this is just that extra step to say, hey, actually, we're not going to give you any favorable tax treatment for those folks. You might have those folks, that's okay, but perhaps, maybe you'll buy or, invest locally.
Yeah, exactly right. And that's a good point. So there are the updates are actually to the underlying expenses. So you have your expenses, and then you have the R&D credit. So like you said, these foreign R&D expenses were never includable in the R&D credit. And of course, the R&D credit is meant to incentivize bringing that onshore. So American companies making themselves better, improving the landscape. That's really what the credit is for. So yeah, it may seem punitive. Otherwise, with the domestic expenses, I think this was a fantastic change to keep here.
Awesome.
So
So what are the next steps if these companies are like, "Oh, I've been taking it, I haven't been taking it, I've been skipping it because I just thought it was kind of a cluster." What should they be doing here in 2025, Matt?
Yeah, absolutely. So some action items here. So we'll break it down into small businesses and larger businesses. Starting with small. So if you meet that 31 million or less average annual gross receipts test in your small business and you've been advertising, it's a good time to check in with your tax preparer just to see if it makes sense to amend. For some people, it could make sense, or to just catch up in 2025 or over 25 and 2026. Important to note here that there is a deadline to amend the returns to make this election. So that there's a 1 year period after enactment to do that. So some urgency here. Still waiting on some more information there, but for some people it could make sense to amend, but that's a great conversation to have with your CPA or tax preparer. Flip side, small businesses with R&D expenses that have not been amortizing. It looks like you're in compliance now with these rules for domestic expenses only because of the retroactive provisions, not for foreign, that's still 15 years, but for domestic, it seems as though you're in compliance. So perhaps there's an opportunity there to go back and claim R&D credits. Maybe you skipped it because of amortization. Could be a good reason to go back and take a look. And then larger businesses, again, let's say that you've been amortizing. Good time to check in with your tax preparer to see how it makes the most sense to accelerate those deductions. If it's over 25, evenly over 2 years, or maybe you want to keep amortizing. And then larger expenses or larger businesses with R&D expenses that have not amortized. So these capitalization rules are still in effect for 22, 23, and 24. So there was no retroactive relief. Good news is they'll all be deducted in 25 if you so wish. And the really good news is that this is not going to be a concern for 2025. Perhaps larger companies, maybe in the AEC space or elsewhere, that haven't taken the R&D credit, worried about amortization. Great time to start thinking if that makes sense for 2025 or future years, now that domestic R&D expenses are not subject to this capitalization.
I think I just heard another tax tack. AEC folks with these energy incentives can also get the R&D. Love to hear it. All right, let's jump into QSBS real quick, Matt. We hear a lot about QSBS and also how a lot of founders or stockholders and tech companies we've served have missed it. So the second time around, they're all over it. This one just got a bit bump.
Yeah, this one's pretty sweet. Really, really applicable to, I think, high-tech companies, for companies, C Corp shareholders. QSBS stocks, 1202 has been in place for a while, but it got a lot sweeter. You can see in those bullet points. You used to have to hold it for 5 years, and then you could exclude up to 10 million from capital gains. That's gone up to 15 million now, along with a phase-in that's pretty great. So if you hold it for 3 years, you get 50% of that exemption. 3 years rather, yeah, 4 years, 75%, and then 5 years is the full. And then gross asset value, that went from 50 to 75 million. So at issuance, you have an additional 25 million there in gross value to still qualify for this. Really exciting for founder investors. Pretty sweet deal here.
Yeah, I think the catch here, right, is this is starting from July 4th, 2025. So
Exactly.
we're going to hear more if there can be some type of issuance of almost like QSBS 2.0 for folks might have had stock before. We'll let some folks straighten that out. But
That's right.
maybe you heard it here first. So if you got stock prior to 10 days ago or 13 days ago, you might be unlucky, but I think there's still potentially a shot to be able to benefit from this is what I'm sort of hearing.
Yeah, for sure.
Another important note is just look this up if you own stock or are about to be issued stock, because there is a time frame where you've got to report this. And I think the theme is early and often. All right, QBI.
Yeah, the big takeaway here is that it's permanent. So that 20% deduction for pass-through entities that's been in place from TCJA is now permanent. Pretty exciting. Another good thing to plan for and speak with your advisor. There are a lot of nuances to it, and a lot of planning you can do to take full advantage. Yeah, so just know that that's now permanent, which is a great thing.
Yep. And if you're a high income earner, take a closer look because you could get some type of phase out on it. Just add salt. If you're in a high income state like Matthew, take a look at this.
This is pretty good. Yeah, I followed this one pretty closely. There was a whole lot of back and forth. It could have been better, but from 10,000 to 40,000. So this is that the cap on state and local tax that can be itemized and deducted on personal tax returns. So yeah, as a resident of California, I'm excited about this. Definitely better. Oh, and one thing else we missed. So yeah, the PTET, another back and forth thing. It was looking like an House version that loophole, if you will, was going to be closed. That was not closed.
All right, so some key takeaways from all these great nuggets that Matt and Abby went through is full domestic R&D expensing is back. Bonus depreciation returns at 100%. That's huge. Energy incentives, while different, but just the timelines have changed. And truly, I know we say this all the time, but the best time to tax plan is now. We're getting a ton of questions, so I'm just going to jump right into the Q&A, and then we can kind of take any of these programs a little bit further, if that sounds good to you guys.
Let's do it.
Awesome. Okay, so one of the questions, this one sounds like it's for you, Matt, would be if these changes affect, I mean, you kind of went into it, right? If it's 31 million or above 31 million or below 31 million, would there ever be a circumstance where there would be refund potential for some of these R&D claimants?
So yeah, there is a refund potential for small businesses. So again, there's that average annual gross receipts of 31 million or less test. And these rules are retroactive. So in that case, let's just say you pay, due to only being able to deduct a much smaller portion of expenses in a given year, you paid a whole bunch of tax. Yes, you could go back and amend that tax return to pick it. So there are some cases, but then also it's important to say that you don't have to do that. You could also take all those expenses that haven't been amortized and deduct them all in 2025. That was the most advantageous. So whenever you're emitting return, there are a lot of considerations, such as cost, et cetera. So good thing to speak with your tax preparer about. There are certainly sometimes where it could make sense. Let's say you sold a business or you filed a final tax return prior to 2025 and you paid a bunch of tax in those years. And you're a small business. Maybe you'd want to amend there. Let's just say that for whatever reason, You have a whole lot more taxable income, uh, even beyond the 174 R&D um, in those years 22 to 24, and then maybe 25, 26 foreseeable future, you're going to be in losses. Maybe it would make more sense to go back and grab that refund, waiting to.
Gotcha. Yeah. And then, as always, carrying the weight of, how much is available on the backside. I have definitely met folks that they want to go after every dollar. And what I mean is like every dollar, we're talking like thousands of dollars, but there's associated cost and time with amending your returns and, risk of audit. So the juice is probably not worth the squeeze if we're only talking about, a few thousand or even $10,000. We're only
So
looking
yeah,
at kind of the bigger
cost
dollars.
and the time, like you said, the time you're going to wait to get that check has to be considered.
Awesome. All right. Two kind of questions. I think you kind of hinted at this, that there's a lot of room for improvement with the energy incentives making a shift, Abby. But do you think that the legislation signals a longer term shift in how the government views energy and innovation incentives? And then I've got a very tactical question here right afterwards I'm going to follow up with.
Yeah, sure. So I don't think it's actually a good indicator of a long-term vision. Now, this current administration, I think, has more of a priority on traditional energy methods such as oil and gas. They've also included in that hydrogen and nuclear. So you're going to see the incentives shift towards that. But in reality, while the solar and wind, I might not say, but like 1790 has historically been bipartisan supported. So I expect again that it will come back when it strategically makes sense and becomes a higher priority. How and when that happens, it's hard to say right now with everything that's happening. There's just a lot of priorities in the current administration, but I do think these will come back. My own personal feeling is that we just can't ignore that renewable energy property and new technologies are going to be the future. And so these incentives will follow suit once everybody's on board.
Absolutely. A tactical question. You had made mention that the project just has to start. Can you give some examples of applicable costs that would be defined as start if there isn't a physical construction?
Sure. It's really anything under the entire project cost umbrella. So, for some of my clients on larger projects, their design fees that are issued out to building owner equal more than 5%. But you can include, again, any sort of costs incurred for getting your equipment and putting yourself in line for getting that equipment on site on time, permitting costs, general overhead costs, initial payments to the general contractor. Really, anything that's directly related to the building being constructed could be included for that 5%.
Awesome. And I think we saw that under the Inflation Reduction Act boost where there was that grandfather period, right? That kind of sweet spot.
Yeah, that's exactly right. That's exactly right. So for a lot of the incentives to be eligible for the bonus rates, you have to meet new requirements via the IRA, or you can be grandfathered in because your projects were already happening when the legislation was passed. And beginning of construction is also the indicator of whether you can be grandfathered in. So if you began construction under those same terminologies, then it would need to be before February of 23, immediately be eligible for the bonus rates, which is great. So if you're looking at past projects, they're still eligible. And I totally recommend that window of time because you'll get the biggest bang for your buck.
Awesome. We've got a question for accelerated depreciation for geothermal. Jonathan is asking, does 100% bonus depreciation for cost seg replace the accelerated 5-year MACRs for geothermal projects? Or just wondering, how would it be different?
Yeah, so that's a great question. So there are two different mechanisms. The 5-year maker's schedule is essentially what you're reallocating that depreciation life cycle to be for geothermal. So what's being referenced there is for energy property that qualifies under Section 48. You get to put on your tax return as a 5-year depreciation schedule. Because it is not considered permanent property anymore under the 39 or the 27.5-year cycles, it's eligible for bonus depreciation. So what what we were seeing before for projects placed into service in like 2024, you get, or 23, you get 60%, 40% bonus depreciation. Now for projects beginning for this legislation, it'll be 100% bonus depreciation. So what will happen is you will reclassify to 5-year, but then you get the full amount in the first year as a depreciation deduction. So it's good for that.
Awesome. Another one for you, Abby. You talked about elective pay. Does that mean nonprofits? And then also, is it still true that designers and private building owners qualify as usual?
Yes, so elective pay is relevant to several incentives, but the one we talked about today is the investment tax credits. Anybody who is registered as a tax exempt organization with the IRS essentially can qualify for elective pay. So that's your nonprofits, your local schools, your state municipalities. The only governmental level is federal that is not eligible. So they can also claim the tax credits through the elective pay program. They get the same amount. It's calculated the same. You just get a check in the mail from the US Treasury instead of getting a tax break. And then for like designers and such, or built, let's start with folks who are private taxpayers and are going to place into service like a renewable energy property system. They can still claim the credit the same way they could before. Again, there's that complication with the foreign entities if that's relevant to you. But other than that, it's the same. And then for like designers of D who are able to claim that deduction, they can claim it with the exact same rules they could before, just with that new termination timeline in mind.
Super helpful. All right, let's see. We're coming up on the 45-minute mark, so we're gonna have to let some of our lunch friends go soon. How can tax professionals and consultants best support their clients through these changes? Who should I be talking to if my CPA isn't telling me these things? Sounds like you and Matt. I mean, one, keep listening to webinars and talking to folks that have, right, the experience and are on the ground would be kind of my general answer there. But, we talk a lot about kind of year-end planning, but it sounds like on your side of the house, Abby, we're talking about these projects, before they break ground, right? Matt, I think we've got a little bit more time in that. We're typically looking at the prior tax year, but now with 2025 in play, is the answer now? I'll let both of you kind of take your stab and viewpoint.
I'll jump in first and I'll kick it over to Matt. Yes, the sooner you can loop somebody in, the better, because like I said, we've got all sorts of different rules for whether it's placed in a service, whether it's starting construction. And to be frank with you, the folks that are filing your tax returns have so much to worry about. They're not necessarily looking out for these very nuanced incentives and these new nuanced rules. So having somebody on your side that's an expert in the space and they can be a partner to those tax teams is critical to make sure that you don't accidentally miss on those incentives. So I recommend the sooner the better, even if you don't necessarily execute the calculations right away, at least your projects are planned accordingly.
Agreed. Yeah. Similarly, I think we always say that being proactive is the best way. So, do you have to do it today? No, but if we're talking about say 2025 R&D credit. Just start thinking about it now. Start documenting. Start putting away information. You can't have too much time to, as Abby said, your tax preparer has a million things, million considerations for your tax return. So time to really think about those tax projections and incorporate some scenarios.
Yeah, and I think on the flip side, I mean, tax professionals, this is such an incredible opportunity to re-engage with your clients, get an understanding
Absolutely.
for what they're working on, and then on the flip side too. I mean, let's face it, we know that our CPAs, like we're one of many, and so we've got to be our own advocate. I think a lot of times people, or what we've seen is a lot of folks assume that because someone files their taxes that they must be covered on everything, and that's just not the truth. I mean, how much time are you actually spending with them? So it goes both ways too, right? With everything, you've got to be your own advocate. You know your business best. So now is a really good time to, do your homework, ask questions, set up another meeting kind of with your financial professionals, and there should be some money on the table after this bill's been delivered, no doubt. All right, y'all. This has been really fun to get to spend 50 minutes with you. I think we still have a couple more questions trickling in. We keep getting asked, will we send this presentation? Yes, we'll also provide some summary points because the slides don't have all of the great context that our experts had. If you have certain specialty incentives in mind and you want to take a second look or talk about your project specifics in detail with our team members, we have an open line. I know these two are drinking out of the fire hose right now because so many people are excited about taking advantage of these credits like yesterday. So you can easily find us at taxtaker.com. Again, we'll send out the deck. It's got all of our emails. We really appreciate the participation, and really excited for these business owners and tax professionals in the year ahead. So thank you everyone for joining us, and to good health.
Thanks all.
Yep.
Bye.
Thanks, everybody. Bye-bye.